Today we're going to talk about HSAs and FSAs. My name is Tony Cameron with TLDR Accounting, and we provide tax and accounting services to small business owners and therapists in private practice. So what is an HSA? An HSA is a health savings account. What happens is you contribute money to it each year, and then you can use those funds for any valid medical expense. There's a list of eligible expenses that you need to follow, and you just pay them out from the HSA account. And then any funds left over carry over and grow to the next year because it's a health savings account. So it's one of those funds where if you're young, you're healthy, you are on a high deductible plan, and you make contributions to an HSA, it can grow tax-free in that account until you might need the medical expenses maybe when you're older, or you have an event happen and say you need to, that you have much higher out-of-pocket medical expenses. Now, an HSA, there are certain rules for it, so you have to be on a health plan that allows you to have an HSA. And these days, they're very clear that this is an HSA eligible health plan, right? Usually it's a high deductible plan. You can either purchase it from the marketplace, or if you're getting it from your employer. Now, you can't be eligible for Medicare and have an HSA. Same with, you can't be a dependent on someone else's tax return. So you have to be getting the health insurance yourself, and you have to be claiming yourself to be able to have an HSA. Now, the benefits to it is, like I said, you contribute money, that's tax-free, and it grows in that account, right? It completely grows in that account, and in turn, you don't pay taxes on any of that growth in that account. So say you're young, you put $1,000 a year in it, and then maybe when you're, 30, you need to pay some out-of-pocket medical expenses. There are all these funds that have been growing for the last, 10 years or so in this account for you. And the other positive is, say you're no longer on an HSA eligible account, you can still use HSA funds. It's just you can't contribute money to it because you can only contribute money to an HSA if it's an HSA eligible plan. Now, the amount you can contribute for 2021, for an individual, it's $3,600, and for a family plan, it's $7,200. So it's a good amount of money that you can contribute right now to an HSA, and either use it for medical expenses or let the excess roll over each year. Now, on the other side, there's a flexible spending account. It's not a savings account. This type of plan, you can't roll over funds. You can only roll over about $550. And currently, because of COVID, there's a 12-month period. Certain employers are letting folks roll over money, but it is employer specific. In addition, a flexible spending account is usually set up by an employer. You can't get one yourself. So if you're like, oh, I want a flexible spending account, it's only an employer provided plan. If you're purchasing your own insurance off the exchange, you would look for an HSA. Now, for the flexible spending account, same thing as the HSA. You need to make sure you use eligible expenses. Money does not roll over each year, except for about $550. Everything over that is permanently lost. So with an FSA, you need to know how much you're going to spend out of pocket on medical expenses. So things like therapy session copays, your dentist copay, your office visit copay. You got to have a better idea of what you're spending on your medical to really make use of an FSA. Now with an HSA, since everything rolls over, you can just contribute the max, and then whatever you use, and it rolls over whatever you haven't used, right? But it all depends on if you're an employee, what your employer provides, right? If your healthcare plan allows for an HSA, I would totally say go for an HSA over an FSA. Now, that changes if your employer contributes to an FSA and not to an HSA, because that you need to factor in as well. I hope you found this helpful. This was just a quick overview of HSAs and medical FSAs.